Okay, good morning, good afternoon, and welcome to all of you. We're very excited to give you our market perspectives today. We've got a great team of financial professionals ready to share their views with you. And I'll be starting off by giving a short introduction and covering a few issues that are out there. I think we had about 1,400 people registered for this webinar, so it's fantastic to share our supposed wisdom with all of you. I think about 500 people have joined the room already. But let's get started to respect the people who've joined on time. So I think we wanted to start off on a happy note, and you'll see the picture on the right-hand side is the picture of a party. I think equity markets, it's always very difficult to predict exactly where they're going in the short term, and the last few years have been among the toughest years we've had on equity markets. We've had COVID, which is something nobody in our lifetimes have ever experienced. Some wars which have kind of torn the world apart and created a lot of inflation and the like. Rampant inflation, which certainly wasn't the expectation. We've had interest rates go up at the fastest rate ever, up from basically 0 to 5.25% in America, and that's got enormous consequences. But we think that the next 3 years hold a lot more promise. So we showed a party indicating that we think there's a few good years ahead for asset prices. I think the starting point is that interest rates are at pretty high levels. So without taking any risk, you can earn 5% offshore in a JP Morgan money market account. But we think the riskier assets, or the assets where it's not that certain what the returns will be, are looking pretty good for the next few years. The key driver of earnings per share of markets around the world is the S&P earnings per share. So that's the earnings of the average US company. And if you look at the bottom right-hand corner, you can see the red line is about $2.20 on the S&P. But we see that kicking up very nicely over the course of 24 and 25 at a rate of about 12 to 15% per annum. And that should really mirror the kind of returns that people can expect over a few years. So going into 2024, the cost of money is coming down. It's very expensive to borrow money at the moment. That will change for companies. Economic growth will bottom. The pressure that comes from higher interest rates is still really got to be felt in the US. So US will have a fairly low GDP growth this year. But once people see the bottom, you certainly want to be invested at that stage. US will return to earnings growth, as you can see in the chart on the bottom right, flat to down a little bit this year. And then, of course, artificial intelligence. We don't really know how that's going to impact markets or companies. And the big beneficiaries have been the Magnificent Seven, as they're called, and Mike Gresty will tell you a little bit more about that. But certainly the productivity of companies, their ability to be more productive, new products, services, etc., will come out, and we'll talk a little bit more about that. So certainly there's an argument that the conditions are returning for some animal spirits. We're very fundamental in the way we look at companies and valuation. So there is some room for caution, as always. And in fact, the narrative is not quite matched by the number we're putting on the table for US earnings, for US returns this year of about 7%. But we wanted to send that 7% with an upward bias. When things are good, people often kind of push valuations quite high, and we think people have to be invested to take advantage of the optionality that comes through. There's of course lots of geopolitical issues, and we're watching that very closely. I think those risks have certainly got higher, but one can't invest on the basis that there's going to be a world war. If you've done that over time, you would have made very little returns on your money. I think also the kind of the drum we've been banging for quite some time is that alternative investments offer some attractive returns with less risk. And here we're talking about private debt, private equity, structured products. And in most of our clients, where appropriate, we've got the structured product alternative asset component of their portfolio. I had a good chuckle when this Bloomberg piece came out the other day. We were trying to work out what our projected returns would be for the year. And there was a Bloomberg opinion piece saying, "Don't worry, Daddy, you're being old-fashioned. This isn't your dad's S&P 500. Don't worry about valuations. Well, certainly statements like that have proved to be very dangerous in the past. But I think the bottom line, as Mike will share with you, markets do look fairly expensive, although the prospects are pretty good. And there certainly is room for a bit of pause. I think if you look at most of the big investment banks around the world, they don't have great projected returns for US equity markets this year, but they say they're much more bullish moving into the end of the year. And if conditions are reasonable, that can happen sooner rather than later. So, like always, we have no certainty as to what's going to happen over the next 6 months. We might have a bit of caution putting new money into the market, but on a 2 to 3 year basis, which one should really look at the market with that sort of time period. We think it looks good. And again, as Mark will show you, underneath the index levels, we're able to find some very attractive companies at good prices. So this is kind of the summary of where we think the money will be made. Decent returns from most sectors. Domestic equity, and by that we mean South Africa. We're talking about a 10% return. Domestic equities are almost the opposite of global equities, where growth is low, but shares are very cheap, kind of half the price. Our favorite sector is actually the property sector. We're talking about a 12% return from there. So not a wildly big return in excess of the 10%, but we think that looks pretty attractive as interest rates come down. Domestic fixed income, we're talking about 10% as well. That's roughly the kind of running yield on bonds. And we think it's possible to make some capital gains. And here, the Anchor BCR Flexible Income Fund, we think gives you nice exposure to that. From a global equity perspective, mathematically, it's quite difficult because of the starting point. It's quite difficult to come up with a wildly bullish number. But we think a return of 7% and potentially much more than that is one of the scenarios. So a high road scenario is priced in. Not everything will pan out exactly as people expect. There could be some bumps along the road. But lots of good companies. As interest rates come down, earnings growth will start to kick through again towards the end of 2024. The stock-specific opportunities are more interesting, and Mark will talk through those. From a global fixed income perspective, the 4 to 5%, you can earn 5% on money market. Rates are going to be cut, although the risk is that takes longer than expected. And a term yield of 4 to 10 years is looking attractive to lock in the higher rates. Our Anchor Global High Yield Fund is yielding about 5.5% in dollars, with bonds maturing in a fairly short time period. So it's a very low risk investment to achieve that kind of yield. And we've added just a component at the bottom, alternatives, which is really it's a vast space, but includes things like private equity, private debt, structured products, etc. Within that, because interest rates are fairly high, there's some very attractive returns to be generated. And we started a fund last year, a fund of alternatives, which is a nice way for people to buy units across that kind of product range. So there's our projected returns in a chart. We recently put out our quarterly Navigator document, which goes into more detail on all of these. And these show the returns that are coming through with about a 3% weakening of the rand. So similar returns from a local and global perspective. So we wouldn't be dumping local equities completely, but with a similar return from global and versus local, we would tend to favor global equities, if for no other reason than the quality, growth, and ability to diversify is significantly higher. So just a quick slide on the listed property sector, and I don't think we've had listed property as our highest return sector for about 3 or 4 years. The property market's been absolutely terrible in South Africa. But we have got to the stage, if you picture what share prices have done, something like Growthpoint's gone from well over 25 Rand down to 12 Rand. A company like Redefine's gone from close to 10 Rand to 3.50 Rand to 4 Rand. So, we think they've got to a level now, or certainly during the course of this year, where, if you picture the average company's got a lease cycle, most of their leases get renewed over a 4 to 6 year period. So you've had about 3 to 4 years of the leases being renewed at much lower rates. And as interest rates get cut, this is the important thing. you're obviously comparing it with lower and lower bond yields. We don't expect those to come back significantly this year, but the trend certainly now from an interest rate point of view is downwards. So in this chart, you can see the kind of dividend yields that are available. From an Epi Rockcastle, it's 8.2% in euros. The big bellwethers, Growthpoint and Redefine, 10.5%, 11% yields. So the projected 12%, which isn't enormously bullish, you can see it's basically taking the dividend yield and saying a little bit of an increase in share prices. But that gives you a fairly solid return. So one of the key reasons that we're giving this sector projected 12% is interest rates coming down and the impact that it has on these businesses, which on average have about 40% gearing. Our pick of the sector in yellow is Mass, which is a European or mainly Central Eastern European high-quality property company. They've decided not to pay a dividend for the next 2 years to fund their capital development, and that resulted in a 20% smash to the share price. We don't think it made any change to the value of the business, and we've got a fair value of close to 30 bucks. It has bounced from 15 Rand to 18 Rand 50 since that call, but we still think there's quite a lot more upside. And then to quickly touch, there's nowhere else in our presentation the guys talking about this, but the alternatives fund that we started in terms of client appetite to invest in alternative products. And this can be quite complex because getting into individual private equity or private debt opportunities is not that simple for private investors. So we've pulled together all of the different alternative investments that we invest in into a fund, with the objective being a double-digit 10 to 15% Rand return with some upside potential. Some very interesting private equity opportunities in here, and if they work, they can give some really good returns. So it's a very nice payoff profile, not taking too much risk. And for those who kind of exhausted over the course of the last 3 years with significant volatility in equity markets, this certainly is a great viable alternative. But your wealth manager or financial advisor can share more details with you. So moving into the South African scenario, from a South African specific perspective, what happens in 2024 and beyond? Post April or May this year, it's going to be different. The population is certainly asking a lot of questions and looking for solutions. And there's lots of expert views out there. There's 3 big events: the national elections, which look to be held around the 22nd of May. The Reserve Bank governor ends his term on the 9th of November, and the SARS commissioner term ends on the 1st of May. Those might well be renewed, but it's not just the elections that are coming through. So from an election perspective, it creates uncertainty. I think the outcome that the market wouldn't like is an ANC coalition with EFF. Just to look at some facts and figures, voter turnout has been a significant factor over the course of the last 25 years. You can see that was sitting at 88% in 1994 and is now down to 65%, which reflects the lack of interest coming through from voters. The ANC votes down from 70 to 57.5. I think there's a lot of people who kind of guessing that can go below 40%, just to make the point that that's a radical view. You very seldom in global politics see moves that significant. But it did go down from 62 to 57 in from 2014 to 2019. So from a scenario perspective, the ANC at 50 to 55, we don't think is a great outcome at all. I think we'll get more of the same. A new ANC president in 2026, in which case Ramaphosa would become lame duck for 2 years, and not a great scenario at all. ANC at 45 to 49%, it would then have to go into coalition with one or a few parties. And that's really the kind of key question. I think it's guesswork as to whether it's heading the DA route or the EFF route. I think the government, in terms of investment in the country and kind of support from business, I think might well go the DA route. I think the EFF is quite abrasive and could create some issues. But here there's a cost to a coalition, And it's South Africa might well have to learn how to operate with coalition politics on a better basis than what they do at the municipal level. So the cost might be the presidency, the finance ministry, deputy presidency, etc. The 40 to 45% scenario, would be a very interesting angle. And scenario 4, which would be ideal for markets, would be ANC below 40 with a Hechter tie with the DA. So those are the kind of different outcomes. I think markets are likely to be volatile before the election. Generally, from a markets and currency point of view, most of the action happens before the election. As soon as something gets announced and people can cope with it, that tends to be a different scenario. And then just a quick word, because we really are in the early days, and we'll be talking about this for the next 10 to 15 years, the impact of AI on our markets. And a very interesting chart from Morgan Stanley, because people say, is it overblown? What's the financial impact? I think the reality is that people tend to overestimate these kind of things in the short term. So after a year or two, it hasn't changed our lives to the extent that people speculated, but then underestimate the long-term effect. And here's just a very interesting chart on the PC, internet, mobile, and cloud computing, where the initial forecasts were vastly underestimated. So PCs in 225 million PC users were expected in 2000. That landed up being 354 million. And so we move along. So it's the AI impact might well have been overblown. I think from a market's point of view, the impact has really been felt on the Magnificent Seven shares, as we'll hear more about a little bit later. But certainly there'll be lots of new players on markets. And, we're very focused on trying to ensure that our investors get exposure in the right way, not get exposed too much of kind of to bubble-like mentality. But it's a very interesting space, and we're spending a lot of time working out exactly where to invest. So that, folks, is the start of the presentation. I'm now going to hand over to Mike Gresty, who's going to talk about global equities.
Good afternoon, everybody. If you'll just bear with me while I get my slides up. Thank you, Pete. As Pete said, I'm going to spend the next couple of minutes just chatting to you about our thoughts on global equities. If I start off, some of my colleagues questioned whether this was a very sensible way to start my presentation as we share our predictions for the year ahead with you. And it's really just an acknowledgement of the fact that, particularly over the last couple of years, if you look at the outcomes that we've got from markets, it's been very much a case of, the degree to which markets and events turn out differently to what was expected. So, as we talk through our expectations for the year ahead, I suppose the message is, first of all, we approach them with a degree of humility. They need to be held quite lightly. And I think we're going to certainly acknowledge that it will remain a case where it's going to be critical to keep an open mind about how events unfold, perhaps differently to expectation. Pete made the point that at the moment, valuations are quite full. There's a fairly high road scenario that is the consensus expectation out there. That being, expectation that we're probably not going to see a recession, a slowdown, yes, but interest rates are expected to decline, and that's a relatively favorable environment and backdrop for equities. But, as he pointed out, that is to a large degree priced in. And I think that the thing that excites us most about equities is when one scratches below the bonnet and appreciating how different the pictures are stock by stock to whatever we may say overall about equities. But certainly from an overall markets perspective, given the high starting point for valuations, we think it's realistic to expect a return from global equities of around 7%. As Pete said, that's going to be our target. So, not spectacular, but certainly respectable. And this is obviously all about that process of compounding over years and not just a one-year view. If we look at where valuations sit right now, this is the chart showing the price as a multiple of expected earnings in 1 year's time for what we call global equities. That's really developed market equities. And understand that this particular index is very dominated by the US. So, it's not very different to what you would see for US equities. And hence, when I talk further into this set of slides, we're going to talk more about what's happening in the US market in particular. But you can see there that with the forward multiple at just around 18 times there, we're looking quite expensive at the moment. Not as expensive as we have been at times, but there's no question a relatively high road scenario priced in at the moment. First point I want to stress is, as I mentioned earlier on, the importance of understanding what's happening below the bonnet. And I think this is often underappreciated by people when they, consider the overall market. There's an assumption that it remains pretty much the same over time, and nothing could be further from the truth. So this is just looking at how the S&P 500 has changed over the last, decade plus. And in the bigger scheme of things, it's not a terribly long period of time. But if you go back to 2009 and look at what were the stocks that dominated the market, it was a pretty diverse range. You had certainly some tech, but there was industrial companies, there were banks, there were pharmaceutical companies, quite a good representation from oil companies. So, I suppose a fairly representative picture of the US to a large extent. Now, when you flip across to the way the market looks today, it's very, very much dominated by technology. And certainly as a result of the surge we've seen in the Magnificent Seven, it's perhaps no surprise that that is the picture as it appears today. And because of how strong that performance has been in recent times, you can also see how much the overall market picture is being driven. It's as if the tail's wagging the dog here, because you have tremendous concentration now. Essentially, the top 10 stocks now account for over 30% of the market. And I think it's important to appreciate that while it's, that mathematically we may say what we do about overall valuations, under the bonnet, the picture is actually quite different. Is it a bad thing that technology now dominates to the degree it does? It's quite hard to say. I mean, I think the one point that often people make today is that these are the real defensive companies of today. They're extremely cash generative, the cutting edge of innovation. Almost in many cases, they're like the Death Stars, sort of absorbing all of the latest innovation out there and benefiting from that. So, aside from acknowledging that it is as it is, I wouldn't want to necessarily put my neck out and say this is a bad thing, but it perhaps explains to a degree why it's important to appreciate that multiples we may have seen in the past for the market are not necessarily entirely indicative of what one should regard as cheap or expensive in today's world, because the companies are very different and their prospects similarly are not going to be the same as perhaps the Exxons and Chevrons of a decade plus ago. So with that in mind, the importance of looking below the bonnet, what we've done here is shown how different the market looks when you strip out what everybody's come to know as the Magnificent Seven. So these shares are obviously the ones that absolutely dominated performance last year. And if you look at the dark blue line there, you can see how that extremely strong performance has pushed up the valuation of that group of shares. And bear in mind how dominant they've become in terms of their influence in the overall market. So if you now have a look at that brown line at the bottom there, which essentially is the forward multiple on the balance of the market, the other 493, as we call them, you can see that it's far less demanding than the overall market appears. Back in 2021, that grouping of shares was on a forward PE of over 20 times. Today, it's on a forward PE of around 17.5 times. It's been cheaper, no question about that. But I think it's important to appreciate that it's really in that grouping of companies that we think a lot of opportunities exist. So, don't be scared off by this belief that markets are expensive. There remain many opportunities out there. I think another thing to appreciate about where we stand today is that we're returning to a period when earnings are starting to grow again. I guess one of the anxieties about 2023 and the strong performance we saw was that it happened alongside a year in which earnings actually went backwards. in aggregate for the US market, which meant that all of the performance from equities was driven by what we call multiple expansion. In other words, valuations going upwards. Yes, earnings growth may appear fairly subdued, but importantly, we're seeing earnings growth. And with the passage of time, that means that valuation multiple is unwinding. And obviously, we're very much in the game. As much as we're today talking about 1-year views, it's that multiple years of steady earnings growth that eventually wins the day. So if I'm to sum up, before we look at a couple of specific stock ideas that we're particularly excited about, yes, we start the year with valuations relatively elevated, particularly after the strong run we saw in the last quarter of the year. And that does mathematically, as Pete pointed out, mean it's difficult in aggregate market terms to find returns much above sort of upper single digits. However, certainly an environment in which interest rates are falling, inflation is moderated, earnings are starting to grow again. It's a pretty healthy backdrop for equities in aggregate. And if that's what we see over the next couple of years, it's certainly an environment in which you want to remain invested in equities. In the very short term, remember that point about outcomes probably being the result of how events come out differently to expectation. Hold these expectations lightly. Be on the lookout for opportunities and how things are turning out differently to expectation. And with that, let's turn to a couple of stock ideas. If you look at the ideas that we had going into 2023, they actually in aggregate turned out pretty well. And that's despite not having any of the Magnificent Seven amongst them. Certainly in retrospect, we wish we did. And that's certainly not to say that we didn't have good exposure to artificial intelligence and those companies in our portfolios, but it's just the handful of stocks that we selected specifically for 2023 didn't include that theme. Where do we think we're going to make our returns in 2024? It's interesting as we look at them that certainly we've avoided very much the beauty parade, if I can call it that, of 2023. So once again, there's no Magnificent Seven there. Obesity control was another area that was very much in favor during 2023, and you won't see any of those names. And each of them probably has a little bit of a fallen angel type of story to them. And often they say about, buying quality compounders, you get few opportunities to get into them at respectable and decent valuations. And a couple of these companies certainly would fall squarely within our wheelhouse of long-term compounders, but for one reason and another are representing, we believe, really interesting opportunities. So first of all, we're sticking with Citibank. It was one of our picks for last year, and very much the same kind of thesis, which has taken a little bit longer perhaps than expected to materialize. But, we think in 2024, you're really going to see the impact beginning to come through of the new CEO's restructuring plans. You're going to see returns improving, and Citibank currently valued at a multiple of about 0.5 times book, with improving return on equity, has considerable potential in what should be a pretty favorable environment for banks to see a strong re-rating. Another fallen angel, I guess, is Estee Lauder. Has had a very difficult couple of years, mainly on the back of issues it's faced from excess stock in China. And you've seen its earnings absolutely collapse and the share price along with it. A really strong brand with exceptionally, long history of high returns on capital. Yes, not going through a great period at the moment, but certainly a company we think at current levels you can put away in expectation of a strong earnings recovery as it gets these China issues behind it. And you'll look back on that as having proved a really good entry point. Another company that's a very high quality business, but currently a little bit out of favor is Rentokil. It made a large acquisition of a business in the US, Terminix, which is mainly focused on termite control. The market currently a little bit uncomfortable with perception that it may have paid a little bit much for that, is currently struggling to integrate the business and has taken its eye off the ball. But this is an incredibly consistent performer over time, got a great model of generating large amounts of cash, redeploying that in a relatively fragmented industry. And as they say, rats don't read the FT. So they're always going to be with us. And as I say, this has been a steady, reliable compounder over time at an unusually attractive price at the moment. Scottish Mortgage Investment Trust is a closed-end fund that is unashamedly a growth investor. Now, this has been a bit of a swear word among investors over the last couple of years. And the other thing is that Scottish Mortgage Investment Trust is listed in the UK, which means it's probably fallen off the radar screen a little bit for investors that have become absolutely obsessed with US listed businesses. Since we've seen interest rates rising and valuations of these, particularly what we call long duration earnings growth companies, fall, Scottish Mortgage Investment Trust has really been on the wrong side of that. But as we look forward with interest rates potentially declining in 2024, it really sets this business up for exciting times ahead. If you look at it historically, between 2009 and 2021, if you had been lucky enough to be invested in this business, it compounded earnings around 16, share price compounded around 16 times. And, obviously the last couple of years have not been great, but it has a selection of really interesting listed and unlisted cutting edge innovative businesses. You've got a lot of the AI names in there, such as NVIDIA, ASML, for example, in that space, as well as some very interesting unlisted businesses such as SpaceX and Northvolt, which is involved in, battery manufacturing in Europe. So some interesting businesses there. And finally, another one that's going through a little bit of a challenging time at the moment, but has been a very reliable performer over time in the form of Starbucks. So, at the moment, Starbucks has come on the wrong side of recent management changes. People worried about it being impacted by these weight loss drugs, and very recently issues around, unionization and people staying away on account of its exposure in the Middle East. We think these are all things that will pass in time. And, in terms of innovation, global growth, very clear double-digit compounder over time we expect, that's going through a little bit of a difficult, relatively short-term issues at the moment, which we think provides a great opportunity. So with that, the few stock ideas that we've put forward, as I say, we still have good exposure to a lot of the technology areas of AI and stuff, even though they may not necessarily be in this selection of stocks, they're still very much within our portfolios. I'm going to hand over to Liam, who's going to talk through our current thinking on the local equity front.
Thanks, Mike. Assuming you can see my slides, let's start slideshow. There we go. Okay, so yeah, as Mike mentioned, thanks, Mike, for introing me there. I'm going to chat to everyone about the JSE and our return expectations looking forward over the next 12 months. Looking back at last year, certainly not as exciting as what you saw globally in terms of equity markets. I think South Africa and China were the standout underperformers in global equities last year. But that being said, South African Rand's terms still delivered an 8% growth, which is slightly ahead of inflation, which I suppose over time is your long-term objectives out of equities. You want to be beating inflation. But disappointingly, for the second year in a row, returning kind of in line with cash. So from that perspective, with regards to how high cash rates are in South Africa right now, not ideal. But interestingly, as the chart there shows, there were diverging fortunes across the different sectors. So it wasn't necessarily just the domestic issues that plagued the South African economy that were influencing our local market. I would say bigger forces were certainly some of the macro-related ones. So rising cost of capital across the world, which obviously has an influence on our cost of capital. So it was quite restrictive, and I'd say that's more of a macro issue. And then obviously out of China and the demand backdrop for basic materials and commodities and export commodities. So if you couple the domestic issues with that. The basic materials sector was a drag on our index, but actually quite a credible performance from financials and industrials. I think the insurance sector was a standout performer last year after some lackluster years, and the banks index continued to grind higher. So quite commendable from the financials in particular. I think they did about 20% last year, and industrials well over double digits. So diverging fortunes on the JSE, and the market that continues to dish up lots of opportunity throughout volatility and noise that you get over headlines throughout the year. Looking ahead, our total return expectation is for 10% in rands, which is in dollar terms probably in line with the global equity expectations. But I would say there's probably more optionality in South African equities. It's difficult to quantify, but the backdrop for emerging markets and particularly South Africa is one where you're coming off a much more depressed valuation multiple, and in terms of its relative to long-term history, I think South Africa, in the context of the premium we used to trade towards EM, but also the premium that developed markets are currently trading to emerging markets, I think both of those present quite an interesting backdrop for South African equities. We often highlight that since pretty much the end of 2015, South African equities have been becoming cheaper and cheaper as domestic issues have become more pronounced. But I think the picture that we currently find ourselves in is that if a little of it had to go right in South Africa, there is a lot of optionality on our market. So the 10% total return that we have projected has probably got the highest forecast risk in it that we've had for a number of years when we do these. Our return expectations are built from a bottom-up view. So we model about 85% of the index from a bottom-up perspective as a research team, and we create return outcomes. And we take into account macro variables such as the interest rates, both domestically and abroad. And there's a lot of sensitivity at an index level to some unexpected lowering of interest rates in South Africa. So I just flexed the number earlier, and if there's an unexpected more 25, 50 basis point interest rate cuts, which we're expecting the trajectory to trend towards cutting at the back end of this year, there would be an extra 10% upside on the JSE. So we think that from an optionality perspective, which is very difficult to quantify, the JSE carries a lot with it going into this year. It should also, the performance of the JSE should also be seen in the context of the JSE having had quite a strong year of outperformance relatively last year. So it didn't get hurt as badly in the market pullback that you saw in 2022. But nonetheless, stuck in the mud equity market performance was relatively unexciting for South Africa. And as Pete discussed earlier, the low growth and low valuation environment is one that's been hampering the JSE for a number of years. The interest rate environment is something that we view as cyclical. So the very high cost of capital in South Africa, which increases the hurdle rate that we use to value equities, those headwinds that we've experienced for the last couple of years should reverse, as Nolan will discuss in the next section towards the back end of this year. Which for certain of our sectors, if I think about certainly in the domestic space and retailers, that the headwind that they've been facing over the last number of years turns into a potential tailwind. And what we've seen over the last few years on the JSE is that the winners have clearly emerged. I think an example with the bigger companies is a company like Shoprite. With the chaos of load shedding and all the operational disruptions, Shoprite emerged as a winner in the retail space. And we think with just a little bit of GDP growth, if we can get that, the earnings optionality is quite explosive on the JSE. So these companies have been operating in a low growth environment for a number of years, but just a slight tinker to that, we think that there's a lot of potential earnings upside across the domestic space on the JSE. So that is a segue into a couple of companies that we want to discuss today. So the mid-cap space, particularly on the JSE, has been a very difficult space, I'd say, since the end of 2015. It went through a number of years of companies being able to achieve good ratings, a lot of capital going into the space, new listings, and I think we've obviously seen a complete reversal of that for the best part of a decade. And one company and sector that we've been very involved in pretty much since inception of Anchor is the education space in South Africa. We've been investors in this space both from a private capacity, but also in the public space for over 10 years. And Curro was the one that we typically stayed not necessarily completely clear, but it was always the one that we had the least exposure to. I remember back in the day we had a lot of exposure to the PSG group, and that's how we got our Curro exposure. But now, come through that and come through all the capex that they've put down and the valuation concerns that there were in the earlier days of Curro, and the business and the investment case that you find now is very different to the one that we looked at or first analyzed back in the 2014, 2015 period. So what we have today is a business that used to trade at a significant premium to its peers on the JSE. I think Advertech is probably the closest comparison, but also globally it traded on a very high multiple. And where you find it now is that it's sunk a lot of the capex and a lot of the risk that was in the investment case in the earlier days around the expansion plan and the stress that you saw on the balance sheet is largely in the at least the capex plan is largely a thing of the past. It's now firmly in the harvesting phase of all the capex that they've put in. And what we should expect to see over the next couple of years is a dramatic improvement in the return on capital metrics of this business as earnings start to be delivered on quite a big capital base. We've even in the last year we've had quite a lot of exposure to Advertech on the JSE, and I would say from where you're sitting now we see more upside in Curro relative to Advertech. So Curro, we on our numbers are getting this business at 13 times forward PE. We're expecting them to deliver compound earnings growth over 25% for the next 3 years. And while the prospects of this business we think have been getting better over the last 12 months, we've seen the rating come off. So this business was certainly in the high 20s at one stage, and it's now down to 13 times PE multiple. That to us is an example of the opportunities that we're seeing. The upside that we've got on a business like Curro doesn't necessarily filter through that materially into our total return for our index because it's so small in the benchmark. But these are the types of opportunities we're still able to find across South Africa, high quality businesses, usually with lower sentiment than other parts of the market, creating a nice entry point from a valuation perspective. And we've just found if you can buy these businesses at the right price, the compounding and the earnings growth comes through and you get some good total returns over the next 3-4 years. So that's one example. And another example is Dis-Chem, which is also, it's actually got quite a similar story to Curro, where initially once it listed, it commanded a very high rating with big return expectations in the short term. Dis-Chem, I think it went through quite a tough period post listing as it had to adjust and management had to necessarily adjust to the listed environment, which is a lot less forgiving over the short term when making business decisions. So I think that when it listed, there was potentially a bit of a naivety from the management team, and it was still run very much like a private company. But I'd say over the last 6 months, our interactions with them, it seems that this business has been prioritizing all the right metrics that we like to place a lot of emphasis on. So things like return on capital employed, return on equity, and we think that the quality underlying in Dis-Chem is very, very much very, very similar to a business like Clicks. Both of them are businesses that we like, and we like the defensive retail space in South Africa. Globally, these businesses tend to fetch, when they're executing well, tend to fetch very high multiples. And you can see in the chart on the screen, Dis-Chem used to have quite a similar operating margin to Clicks, and kind of lost its way a bit between 2017 and now. And we think that a lot of the noise that you're seeing from between the revenue line and the profit line for this business is largely going to be a thing of the past over the next 2 or 3 years. And we think that you're going to start to see quite nice uptick in margins for Dis-Chem going forward. So we think that margins can trend towards 6%. We think that there's a strong focus on capital discipline and cost control efficiencies in the business. And at the moment, on our numbers, we're picking this business up on about 20 times forward, with 25% or at least 20% earnings growth CAGR over the next 3 years. Interestingly, the founder, Ivan Saltzman, appears to have sold some stock last week. We saw quite a lot of stock going through the market on Friday, about 6% of the company. It was one of the risks, the tail risks that we had identified in the investment case, was just how big his concentration was on the ownership and his involvement and influence he has over the business. Him placing stock and the market absorbing it in the market, it has, for us, we see it as a positive. We were expecting him to be placing stock, which we thought potentially was an overhang on the stock, but seeing it placed so easily like it was last week, we've only seen the stock go through the market, so we are speculating. It hasn't come out on SENS just yet, but we see that as some of the overhang being able to be dissipated, and for us, we see it as a net positive. So those are some of the opportunities we're currently finding on the JSE right now. We like them going forward. They're in the mid-cap space, which is part of the unloved part of the market in South Africa. But these types of opportunities are, if you can identify enough of them, you can generate good total returns out of them. And our process is able to identify a handful of these. I think we've also got Afrimat's another one where we had it on our top pick list last year, and we've kept it on our list this year, which is another high quality mid cap on the JSE. So in the chaos and all the turmoil that you're seeing across the market and negative headlines, we're able to identify fantastic businesses and not have to overpay for them, which is probably one of the more unique features of the JSE right now. And with that, I'm going to pass on to Nolan.
Hi everybody, and thank you for dialing in to listen to where the money will be made. Thank you for sticking around. So the way I look at it is, if you look at 2024, what you've really got is the market's going to be driven by 3 overwhelming key factors. Certainly from the outset, it feels that way. The first is elections. Peter Armitage has spoken about that. The second is earnings growth, the capacity of South Africa to grow. Liam's spoken about that. And then earnings growth versus price and multiples in the US in particular, but globally. Mike has spoken about that. The other factor that's going to drive markets is interest rate cuts. And I get to talk to you about interest rate cuts for the next 10, 15 minutes or so. And I really want to get going because this is quite exciting. Certainly if you're a fixed income person, it's exciting. And from my perspective, the big event in life was actually in December last year. And that was at the US Fed's last meeting. And this is the headline from Reuters the next morning. And basically what has been dominating the last 3 years has been the narrative of inflation is too high. We need to hike interest rates. We need to get positive real rates. We need to keep rates higher for longer. And this high interest rate talk has obviously put all financial assets, all risk assets under pressure. And we felt that. We felt that in equities, we felt that in fixed income. People spoke about 2022 as the worst bond market in history. These have been some of the pressure points. Roll on December 2023, and the Fed comes out of its meeting and says, people, narratives changed. We need to start talking about interest rate cuts. And this was sort of music to the market's ears. We saw a big December rally, Christmas rally. That's what the market was wanting to hear. But that also changes the narrative. It changes the outlook. And all of these things we've been fighting against for the last 3 years suddenly start pushing us in the right direction. And that's the excitement that we are feeling within our business at the moment. Looking at it in more detail, really what it's going to be about is how fast interest rates are going to be cut, both in South Africa and abroad, and how deep those cuts are going to be. So we've got here a chart just for info, which shows you the US interest rate cycle. You can kind of see the hikes and then the emergency cuts into COVID. And then you can see what was the fastest hiking cycle in history. We've been through that, we've felt it. But more importantly, at the end there, you've got the dotted lines which show you that the expectations are for interest rates to come down. Nobody can really tell you how fast interest rates are going to come down. And, there's a bit of speculation in the market. And the way to sum it up is there really are three scenarios. 2023, the US economy surprised us all. It surprised us by being so strong. Interest rate hikes shrugged them off. The economy kept growing. It grew faster than expected. And what if the US economy just is strong? And that means that in the current year, it keeps chugging along, keeps delivering sort of robust economic growth. In that environment, if your economy is growing well, why would you cut interest rates? And you get to the scenario that, in a strong economy scenario, actually the cuts are going to be far fewer. I think there are technical reasons that they will cut, but you end up in a sort of world where the interest rate cuts are maybe 0.75% over the year. We ascribe maybe a 30% probability to that scenario. You then get to our base case scenario. It's actually also the market's base case scenario, which says, look, the cumulative effect of what's been done to this US economy is going to start to slow it down. We expect that US growth is going to slow down, particularly in the first half of this year. And then into year end, it'll probably reaccelerate a bit, but it's going to be a sort of slow growth 2024. In that sort of scenario, we expect US Federal Reserve will cut interest rates by 1.25 to maybe 1.5%. So 1.25, 1.5% of interest rate cuts. We give that maybe a 60% probability. And then finally, you've got a scenario where the US economic growth is derailed. Let's not forget, we've got geopolitical tensions. We've got some really random elections out there. We do have, some fracture lines in the US economy. And any of these things could unexpectedly sort of blow up and create a situation where the economic growth is derailed. In that sort of a scenario, we're talking about emergency interest rate cuts, kind of like you saw in the COVID scenario. We're talking 3%, possibly more of interest rate cuts. And we give that scenario a sort of 10% scenario. But by far and by away, our expectation is US economic growth hits a speed bump, and we're talking about 1.25 to 1.5% interest rate cuts. But what's in the price already? What are bond markets expecting? So we look here at the futures market, and you've got a graph that shows you over time the amount of interest rate cuts that are expected in the market. Very importantly, the Fed is busy meeting at the moment, and you can see here right at the starting point, no interest rate cut expected at this meeting. More importantly, if we go to the end of the year, which is the second last bar here, you can see on the right-hand side that we're expecting 6 interest rate cuts of 0.25% each. The market is pricing in 1.5% interest rate cuts. That's fully pricing in that scenario I was talking about, our base case scenario of actually growth hits a speed bump and then really accelerates into the year end. There's no more juice in that trade. There's no more juice in positioning for that. The market is fully pricing it in. The market is forward looking, which makes a lot of sense. It also says that there's a very sort of consistent view within the economy right now and within market participants that that's the most likely scenario. But what does that mean? How does that play out for investment returns if we do see that scenario play out? And what you end up with is a scenario where most of your return is going to come from interest accrual, from the yield that you earn, the interest income that you earn on your bonds. And at the moment, that's somewhere around 4.5%, depending on what bonds we're talking about. And then you're going to see slight capital gains as a sort of confirmation process that takes place as we move down this path and the market realizes, yes, we're on the right path. So we're talking about bond returns of about 5 to 6% is the most likely scenario. And possibly if the narrative starts to shift, we end up in a more volatile world. But by and large, that gives us dollar bond returns of 5 to 6%. Summing it all up, cash is still interesting. We're talking about cash returns of 5% right now in US dollars. We do need to think about interest rate hikes or cuts, and positioning for those. Yes, a lot of the juice is taken out, but there is still more in the trade. You're going to need to be a bit patient. But term yields of 4 years to 10 years, certainly attractive places to invest money if you're looking slightly longer term. And we like the Anchor Global High Yield Fund. It's got a sort of net of fee investment yield of about 5.5% at the moment. And as Peter said, shorter dated bonds, so the risk is actually quite reasonable within that portfolio. Looking domestically now, what have we really said? We've said it's going to be a somewhat supportive global environment, but what about domestics? Well, what drives the domestic market? And everyone always says, well, it's the credit risk in South Africa deteriorating. So interestingly, what I've done is I've charted the cost of buying credit insurance on South Africa, the South African government, over time since 2010. And what you will see is a couple of things that I want to point out. Firstly, it's quite volatile, so it's all over the place. But there is a definite trend that is developing, and that is the cost of insuring against South African debt is becoming more expensive because, to be honest, there are a lot more risks in South Africa than there were a decade ago. Makes sense. But the other point I will make is that that trend line up to now has actually been very, very gently upward sloping. It's not been a runaway upward sloping. It hasn't moved by 5%. If anything, it's moved by like 0.5%. And that's not the key thing that's actually been driving our markets. I think it may well become in future. It is a worrying trend line that it is upward sloping. But right now, our bond markets have really been driven by two things. And the first is the upwards move in global interest rates. That's repriced South African bonds as well. And the second thing is the oversupply of South African bonds. And what I mean by that is that the growth in government bonds that are being issued is far bigger or far faster than the growth of our economy. So you end up with government bonds starting to crowd out other investments, and that's putting pressure on the market, and that's had a meaningful impact on bond yields as well. The combination of those factors will continue to actually sort of play out in our market, while the credit risk seems to be on a deteriorating basis. Pulling that all together, though, what have you really got? You've got a tug of war. You've got a mildly positive global environment. You've got negative domestic fundamentals. I don't need to talk about load shedding, the fiscal balance, the current account deficit, all the other things that that we can pull out. There's very little to be excited about. I think the election is going to keep us on the back foot for a while, and that's going to be in a tug of war against this positive global environment. Net, what do we think will happen? We think that the global environment probably wins out. It's probably a slightly stronger factor, so there's possibly a little bit more upside in bonds. But we think it's a very tight race. We think it's a close call. And that really means that we're saying in domestic bonds, you're going to earn your interest income, the interest yield on the portfolios. Now, the interesting thing is interest rates are quite high in South Africa. So across the board, that means we think you're going to earn somewhere between 9% and about 10.5% on your various income options. And just summarizing those, because I haven't done that in a while actually in this forum, if you look at the South African interest investment opportunities, a lot of people look towards money market funds, very stable returns. You can see that if you want that expected line is dead straight, but you're going to earn about 8.3%. Anchor doesn't believe in money market funds. We think that there are better ways of investing your cash, and we prefer core income funds, which adds a little bit more risk to the portfolio. We invest slightly longer term. We invest in slightly more South African corporates, but just by being a little bit more sensible, what we're able to do is earn a return of about 9.3%. Very importantly, it's still a very, very stable portfolio. You invest 100 Rand today, in a month's time, you've got your 100 Rand plus 1 month's worth of interest income, and that interest income at the moment is about 9.3%. As interest rates get cut, that's going to come down slightly. We do think that on balance, there's a slight preference for bonds, a slight preference for risk, which is why we like the flexible income fund. And what we're saying is take a little bit of measured bond exposure, measured risks in your portfolio on top of investing just in cash-like products, and you're going to earn 9.8%. And that makes a lot of sense to us. It's a measured risk. If it goes wrong, it's going to be a very gentle impact on you, but it's probably going to slightly outpace core income over the next 12 months. And then finally, for people who can stomach more volatility, longer term views, the bond fund is still giving you the best returns. Summing up the domestic income, where will the money be made? Interest rates are high at the moment. Your yield accrual of 9% to 10% on just holding income products is attractive. We, over the next 18 months, are talking about 1% of interest rate cuts for South Africa. Certainly that's what the team here at Anchor is talking about. And our expected return on portfolios all very much in the same sort of zip code, 9 to 10.5%. And we prefer the Anchor BCI Flexible Income Fund, great yield accrual plus a little bit of sort of capital market volatility as well. Finally, pulling it all together, I need to talk about the South African Rand. Anchor follows the purchasing power parity model. I've had this up here quite consistently over the years, where we look at how the inflation differential between South Africa and the USA moves, And we say that over long periods, the rand should follow that. In the short term, unfortunately, the South African rand, excuse me. In the short term, the South African rand is not watching our chart, that's for sure, and is trading way away from our chart. And really, the rand is trading a lot weaker than the purchasing power parity model, the PPP model, would seem to imply. There are good reasons for this. Current account deficit was a positive 2 years ago. It's expected to be minus 3.5% next year. So that means South Africa needs to fund a lot more US dollars. There are a lot of risk factors around South Africa. There's the natural sort of overhang of elections, uncertainty, and just concerns around South Africa. So we think that in that sort of environment, it does make sense that the rand trades a little bit weaker than our fair value. As I said, for bonds, we're in a world where we think that there's this tug of war, a more forgiving global environment, coupled with, South African fundamentals remain quite negative. And who wins out on the tug of the war? It really is a stalemate. So what we really are saying is that, we're projecting the rand in a year's time at 19. Broadly speaking, that's in line with where it's at right now. So we think it's probably going to sort of bumble around in these levels, sort of bouncing around as certain events play out in the economy. But we don't see the propensity for a massive rand recovery, and I think that's the key message I'm trying to give you. Which kind of means if you are looking to externalize cash, if you are looking to move cash abroad, we think that this is as good a time as any. And with that, I'm going to end my presentation. Thank you very much. And I'm going to hand over to Nick Dennis to bring us home. Thank you very much. Nick, over to you.
Thanks, Nolan. And I'm in the lucky position of not having to provide a forecast or a prediction. And I'm going off on a slightly different tangent relative to the previous speakers. And I'm going to talk about investing, a source of investing wisdom that is maybe somewhat unusual relative to what you've come across in the past. Now, as a fund manager, even before I became a fund manager, I've always been passionate about reading and passionate about reading books about investing and trading. So on your screen, you can see 3 classic investing and trading books that I've really enjoyed, that I've sort of, to me, are right up there. 2 are by Peter Lynch, former fund manager at Fidelity, who had an amazing track record. Very, very accessible. The book's very easy to read. And then the other one is a whole series of books called Market Wizards by Jack Schwager, and that's really more about trading. But there's fascinating insights in that book. Now, it's been a really long time since I've come across a truly outstanding investment book. They tend to be kind of repetitive and don't come up with much that's new. But more recently, at the end of last year, I came across what I think is a little gem of a book, and it's called What I Learned About Investing from Darwin. So it's by an Indian fund manager who lives in Singapore. His name is Pulak Prasad, and he works for a company called Nalanda Capital. And they focus purely on Indian equities, and their style is to buy these businesses and ideally hold them forever. Now, the premise of the book is, so Prasad has got this fascination with biology and the study of the natural world, and then he studied Charles Darwin, and it really goes into depth about the natural world and these discoveries of Charles Darwin, who is the father of evolution, or the study of evolution, at least. Now, what this book does is Prasad has found that there are parallels between the natural world and the world of business and markets. And so in the natural world, organisms find all sorts of ways to survive, adapt, thrive, and grow, depending on their natural environments. And in the same way, companies have to survive, adapt, thrive, and grow in their environments. And so he's drawn these 2 worlds together and said, well, what can we learn from the natural world and how organisms evolve, and are there parallels with the world of companies and investing? And so I've drawn 10 lessons from this book, or probably more than 10, but I think there's 10 sort of key lessons that I'd like to share with you. Now, you know, there are certainly there's certainly overlaps between the Lunda's philosophy and Anchor Capital's investing philosophy, but it's not one for one. Nevertheless, I think for anyone who's interested in investing, you can always learn from other investors, and particularly successful investors. And Nalanda's track record has been outstanding. So certainly, I think there's investing lessons that we can all draw from the book. So particularly if you've got a horizon of forever, like, you know, Warren Buffett says our favorite timeline or holding period is forever. And if that's your starting point, then it almost goes without saying, but it is really worth saying, that there are very, very few good companies and good investments in the market that could really stand the test of time. And so maybe this is the key insight in the book. And if that is the case, then you really need to reframe everything with that in mind. Now, you know, moving on, and this really reminds me, the second lesson reminds me of Buffett's lesson, where the first rule of investing is don't lose money. The second rule of investing is don't lose money. It's easy to overstate this, but so errors of commission are, I buy a stock, I've made a mistake, the stock goes down. Errors of omission are, I didn't buy Tesla or I didn't buy Apple and it went up, you know, 1,000%, 10,000%. And so Prasad, what he does is actually proves mathematically that errors of commission, and I find this somewhat surprising, but he proves it mathematically, that errors of commission, buying a stock that goes down, is more harmful to long-term returns than errors of omission. But what he also shows is that we can make a bigger difference to our future performance by focusing on reducing errors of commission rather than reducing errors of omission. Now, if your starting point is just survival, because if you're going to thrive and survive, the first thing that you have to do is survive. And so companies, in order to survive, have to be robust. They've got to have a strong competitive position. They've got to have a strong balance sheet, and they've got to be able to survive. So survivability is like everything. And so with this framework in mind, is in order to thrive, we first got to survive. We also come to point number 4 is, at least in Nalanda's assessment, is the first thing we've got to take care of. It's not valuation, it's not even quality, but it's risk. Can this thing blow up? And so they almost avoid debt, companies with debt completely. They avoid companies with the potential to be technologically obsolete. They avoid those completely. I'm not saying that's the right approach or the only approach, but it certainly bears thinking about. The first thing is you've got to take risk off the table. And any investment approach has got to work out, okay, how much risk are we going to take, and do we take it off completely? Start with risk, then think about quality, and then valuation comes last. Valuation is very important over maybe shorter horizons, but over the long term, what matters ultimately is the ability of the underlying business to compound. You can't compound if you go bankrupt in the process. An interesting concept that came up in the book is this idea of convergence. So what convergence means, and you see it in the natural world, is animals or living organisms often come up with similar solutions to similar problems, or similar environments. So they might come up with similar ways to fend off predators or to attract a potential mate. And you see this plants, birds across the natural spectrum. And the lesson that he draws for companies is actually successful businesses often have this core idea or concept or like a business model that can be similar across companies that might not appear similar on the surface. And so how he's used this, for example, is to see, well, we've seen that there's successful business models in the United States. Let's see if we can apply them in the context of India. And one way of looking at maybe an interesting example is looking at example of Apple. Now, in Apple's case, the better insight to have had would have been to see it almost as a consumer staple company where we're interacting with this device on a daily basis. It's almost like a consumer staple. At the same time, it's also got attributes of a luxury company where we see it as desirable and almost like a status symbol. Those would have been more useful insights than to get into the nuts and the bolts of, well, what chips go inside, how do they manufacture it, what is the supply chain, all that kind of thing. So, and those, we take those lessons from other parts of the business world. Now, importantly, going on to point 6 is, you know, if great businesses really are super rare, then you really want to hold on. And if the market gives you opportunities to buy these businesses, and it's not for all businesses, it's really for the highest quality and businesses that are the least subject to change over time. But then you really want to use those opportunities, when the market throws up volatility, use those opportunities to buy and not to sell. Now, I've got probably a slightly different take on this, where I think, you know, I'm not opposed to if things get ridiculously expensive on the upside, I'm not opposed to at least partially selling. That's not an approach that they take. But nevertheless, certainly when it comes to volatility to the downside, it makes sense to use those opportunities to buy. Perhaps a surprising thing that came up in the book, and he goes through the statistics, at least in the US market, is there is a surprising amount of persistence amongst companies that were in, say, the top 100 or 500 companies in the world, say 30, 40 years ago, and what are the top 100, say 500 companies today. And so what he proves is, yes, there is change in the world, and it seems like the world is changing faster than ever, but there's still a surprisingly large group of companies where actually stasis is the default, and things actually don't change as much as you think. So take the example of McDonald's for example, like McDonald's or Coca-Cola, they're still around, they're still growing, maybe not extremely rapidly. Walmart, you know, decades later, they're still there, they're still executing, and they haven't become obsolete. So the point is, you know, if you've got a great company like that, rather bet, his argument would be, bet against change. Don't bet on change, because change is not actually the default for the truly outstanding companies. So they've come up with this line, and this is point number 8, which I really like. It's, you know, taking all of this into account, you need to be a lazy buyer, and in this case, laziness is a virtue, which is quite nice. That means just be really patient. You don't need to buy every single ticker, and you don't need to buy every single day or month. And even more importantly, be an even lazier seller. So be a lazy buyer, wait. And then once you've bought something that's super high quality, be even more reluctant to sell. An interesting insight is, so we know the story about compounding. We also preach it, but I suppose the difficult thing is, and you hear these stories about, you know, people bought Berkshire Hathaway however many years ago, they bought Apple how many years ago, and now it's, you know, they started with $10,000 and now they've got $10 million or whatever the case may be. The thing that's challenging is that takes a super long time to happen. So it happens very slowly, and then the nature of compounding is, and this only sort of happens later in the story that you see those outsized effects. And once again, it's really a call to patience and to let these natural forces play out. And they do, it sort of happen slowly, and then suddenly quickly. But you can't, unfortunately, you can't hurry up the process. And then finally, I think, you know, I have a natural tendency towards optimization. You want to find the best investment in the world. But actually, the more robust strategy is really just to find, you know, to have a really robust, ideally simple process, and one that's repeatable, that you can come in day after day, week after week, month after month, year after year. if you focused on finding the best investment, the odds are you're more likely to mess things up than if you just focus on something that's really simple, really repeatable, and just execute that consistently. So I think my final takeaway from the book is I found it quite comforting, actually, that in this world that seems, so frenetic, so fast changing, you've got to have an opinion about everything. You've always got to be doing something. At least that's the way it seems, and that's what financial media might project that image. Actually, there's a quieter way of doing things, a way of being patient and disciplined that can be remarkably rewarding over time. And I think a great example of that is the image on the right. That's Charlie Munger, who passed away fairly recently at the age of 99. And it was someone who really espoused these values of just being really patient, being really disciplined, sticking to your knitting, doing simple things, and mostly just cutting out those errors of commission. So yeah, I think there's certainly a lot that I learned from this book, and I hope you have too. And with that, I will hand back to Peter.
Okay, Nick, can you hear me?
Yeah.
I could just ask the others to come back on screen. Having a bit of an issue getting the video back. So thanks. We've had an excellent session. I just want to pose a few questions to that have come through in the forum. If anybody wants to add another question, go to the Q&A. Liam, perhaps if I can start with you, a question about Platinum shares. I think we've been negative on them for quite some time, but after the massive drop that they've had, what happens next?
Yeah, thanks, Pete. Good question, and I'm going to try and speak a little bit louder. I think that there were some concerns that people couldn't hear me. So the sector, listen, as a house, I think if we stick true to our knitting, it's definitely a sector and part of the market that we're not going to gravitate towards over time. We've spoken extensively at Anchor about the focus on quality and consistent return on capital over long periods of time as key tenets of an investment philosophy. So the sector being so cyclical has been one that we've not wanted to anchor ourselves into and get stuck into investment cases there. But certainly, as they became bigger in the indices in South Africa, we had to pay a lot more attention to them. Where they find themselves now, if one believes in the cyclicality of the industry, you would probably conclude that we must be near or at an operational low in these businesses. The structural headwinds on internal combustion engines, which is the key industrial use for PGMs in general, seems to be getting more aggressive, that we're probably not going to be building many of them, certainly if forecasts are to be believed in the next 10 years. So I think that when sentiment gets smacked like that, it creates opportunity. It seems as though people are forecasting that we're going to have no internal combustion engine cars being made in 10, 15 years' time, and it seems unlikely that that's a plausible outcome. So yeah, I would say that where they find themselves now, they're probably close to break even. I think a company like Sibanye is loss-making, materially loss-making at this PGM basket price, and the sector probably does have quite a lot of optionality in it. But we, as a house, I think our last discussion on it was a day or so ago, and as a process, we're certainly wanting to see some kind of operational trough and signs that earnings will inflect positive again and potentially miss some of the initial upside in the space, and that's what the approach we've adopted as a business. So while we appreciate that this thing is, or the sector's looking at its bombed out cyclical lows, we as a house are not going to get involved until we see some kind of positive inflection on earnings.
Thanks, Liam. So there's a question here from one of our attendees, and I'm just going to read it out because I think it mirrors a lot of the issues and anxieties that we have in ESA. Just a statement. My perspective, worrying road ahead. Maybe a bit of scenario planning would have been great, taking cognizance of infrastructure challenges, Transnet harbors, large businesses, mining industry. Where would the change come from? Elections impact would take a while to filter through irrespective. Should I take max of money offshore? Interest rates could still be overpowered by election and political interplays. All of which makes me feel so uncertain and almost still in a hurry up and wait model. So I think, in terms of all of our communications with clients, it's a lot of what we experience. And South Africa is a troubled place, and we certainly don't look to be repairing a lot of the damage that's been done. So how do we transmit that through into investment markets? I think once somebody's got their living costs covered, we're big proponents of having a large portion of your investable assets offshore. You should put yourself in first and foremost, it's SA versus the rest of the world. But secondly, or probably more importantly, the diversification benefits, the 6,000 companies you can invest in globally as opposed to the 50 in SA. So, interest rates are high in South Africa for a reason, to try and retain money here. There's nice yields and returns to be earned. But we're certainly not advising people to maintain the bulk of their investment assets in the South African world. There's lots of products and funds that we've got that invest offshore. A lot of the stuff that's listed locally, our equity fund that Liam would have been talking about has got probably about more than 50% global exposure. So work with your wealth manager or IFA to ensure that you've got the right type of exposure. And then, Nolan, perhaps you want to comment. I think the equity market, you can take a completely global offshore exposure kind of view from an SA perspective. In the fixed income market, it's really the extent to which you compensated for the SA risk by the bond yields and the like, which I think Nolan has talked through. But maybe just any comments you want to add, Nolan?
Sure, Pete. I think you frequently say that the South African rand on average depreciates by 4 to 5% per year. And, that's the long-term sort of view. If we look at South African income products, the risks we're all talking about are exactly the reason that the interest rates are much higher in South Africa. And that's exactly the reason that I'm saying, many of these income products are going to generate 10%. Now, if we say, well, if I go and buy a dollar income product, what's going to happen? We think in the current world, the rand's maybe only 3% weaker, but on average, 4 or 5% weaker means that, you're earning 10% in rand, that's sort of 5-6% in dollars over time. Actually, that's quite appealing. And there's a lot, because you've got that higher interest income in South Africa, you've just got so much more cushion to absorb potential shocks. So over time, what you tend to find is a lot of economies that are being structurally mismanaged. The income products tend to be domestic income products, whereas the equity opportunities tend to become more exciting offshore, just because the cost of capital in the countries becomes higher. And we are seeing a part of that phenomena play out. And certainly from an income perspective, I actually think, cast your mind back 2 years, US income interest rates at 0, South African interest rates still at 6-7% in cases. It just made a lot more sense, and will continue to make a lot of sense to earn your income in rands and earn your capital gains in dollars.
Thanks, Nolan. Mark Gresty, if I can shift over to you. A lot of the money, as you indicated, has been made out of the Magnificent Seven. What do we actually expect them to do against the S&P for the next 2 years? And how much exposure would you have to them?
Thanks, Pete. That's a question I think we're all asking ourselves. And as I'm sitting here, I'm thinking of Nick's point that we should be lazy sellers. And I think I touched on this issue when I was presenting earlier on, highlighting how big these companies have become by virtue of how strong the performance has been. And what do you do with that? Because there's absolutely a school of argument that these are incredibly strong businesses with great moats, generating lots of cash. They're the defensive businesses of today. So, what I would advocate is, it's not an all or nothing call. Would I be selling them in aggregate? No, I wouldn't. But I think it's important to, after a period where you get such outsized performance from an area of your portfolio, and that's hoping that one is being fortunate enough to be well exposed to them, is, to take care of a bit of housekeeping, appreciate that, you're likely to be starting to create a large exposure within your portfolio to a specific theme, which can be dangerous. As much as you can make the argument these are incredibly powerful companies at the moment, they're also at the bleeding edge of creative destruction. These are perhaps not the sort of businesses where you can bet, as Nick was talking about, on nothing ever changing. Quite the opposite. So, maintaining healthy exposure, but appreciating that there are many other areas of the market that are looking better value at the moment, and also are high quality businesses. So it may appear a sort of hedged answer, but it's not out of them in entirety, because there's still a great story attached to many of them. Expect, I would also say, more of an idiosyncratic performance between businesses. We're also starting to see that. Tesla, for example, has had a more challenged start to 2024, and that variability in performance is probably going to become more evident. So look out for that.
Cool. We're going to have one or two more questions. There are some people asking about slides. They will be made available. Contact your wealth manager, or send an email to info@anchorcapital.co.za. And a lot of this is also contained in the Anchor Navigator, which is our quarterly document, which can be found on our website. Nick Dennis, some questions about Chinese equities. I think probably the biggest disappointment of 2023. After a very poor year, what do we do now?
Yeah, it's a tough one, because last year you had many of the same arguments that you've got now, and equities were cheap. They were opening the economy, so you thought at least base effects should be favorable. They were stimulating, and then even on a bottom-up level, companies seem to be doing more of the right things that were favorable towards shareholders. But with China, it often seems to be a case of one step forward, two steps back. And I think the disappointing thing is that the reaction from the authorities has been sort of really quite piecemeal and quite reactive, and they seem to shoot themselves in the foot quite often. So, yeah, I mean, there have been some idiosyncratic stories that have worked really well, like PDD in e-commerce. We've got Temu, which is growing like wildfire globally. But Chinese equities, just without that, have been really stuck. More recently, there have been moves that they want to stimulate more, that they want to do, that they are at least concerned with the fall in the equity market. I mean, the approach that I'm taking is, yes, there's value there. In some of our mandates, we've got Chinese exposure. I want to give it a bit more time, give it a bit more time. Let's see what happens at the economy level, the policy level, and then at the company level. But I don't want to give it endless time, and so it's kind of a watch this space. Like, I'm not sure that I'd be adding here. And if we're still having the same discussion in 6 months and nothing's happened, I would move on.
Okay, then two political questions. One, the impact on South Africa's ICJ case against Israel. Will it have a negative impact on SA equities? And then the US election and how we're positioning offshore to take account of what might happen there. Maybe I'll let Mike Gresty talk a little bit about that. From an Israel and the International Court of Justice perspective, I don't think, these kind of political moves don't tend to have a big market impact. They can have an impact on sentiment over time. Clearly, the positioning South Africa has taken is kind of anti-America in a number of instances. If you look at, the support and who we're giving contracts and tenders to, we're kind of positioning ourselves with a certain segment of the world. But, I wouldn't, in the short term, I wouldn't imagine that there's any kind of equity market impact. Generally, the way to look at it is from a political move perspective, are the things that are happening going to change the medium-term GDP growth trajectory of the country? And it's those things that tend to have a big impact. From a US perspective, we obviously watch it very closely. If Trump comes through, if you remember, a lot of Trump's moves when he was in power previously had a very positive market impact. It was very market friendly, and the market did pretty well. So one's got to look at who's being favored. It is a long time away. I think the elections are, if I'm not, I think November. So it's not something that one can predict or kind of position a portfolio at the moment. But maybe, Mike, if you want to add any more insights to that.
Sorry, Pete, can you just repeat that? There were a couple of questions there. I wasn't sure which one you wanted me to.
Yeah, so just talking about the impact of the US elections on the offshore portfolio.
Got it. Understood.
And how we would deal with that.
So yeah, it's a really interesting question, and I think people tend to look at what happened last time, and maybe because that is a happy story. People went into the Trump presidency quite anxious, and as it turned out, it worked out quite well for investors. And I suppose the question is that the outcome we're going to see, which remains very much up in the air? What I would say is the concept of, if that's the way we go, a sort of more laissez-faire, less regulation, more pro-business orientation leads me to believe initially that might be a positive development. There's certainly some areas, given the direction that the Democrats are going on regulation, that I'm becoming a bit anxious about in terms of when it's going to land and impact businesses. But I have to say, further into a Trump presidency, I become increasingly anxious about, what might happen if we see some of the more negative aspects. So, my immediate positioning is, I think a change could be short-term good for equities, but I would be watching for, as that presidency was to continue, for more of the negative issues, as perhaps more protectionism, those kind of things just spring to mind. So again, a mixed answer. Short-term good, long-term, I would say not so good.
Okay, guys, we've gone over our allocated time and the time that we promised the viewers. So there are a few questions that we haven't been able to get to. But thank you very much for all attending. I hope we added value to your lives' perspectives, and look forward to seeing you next time. Cheers.